Hi, my name is Willow. I am certified financial planner and founder of Willow Wealth. Today, I'd like to share my thoughts on short-term investing. I will mainly analyze this from three perspectives: time, risk, and taxes. First of all, time. As we all know, doing day trade means that you buy and sell securities within one day. You make profit by taking advantage of the price fluctuation. So as investors, in order to make money, you have to spend a lot of time doing research on the market and the company that you invest in. You also need to be good at technical analysis. Personally, I don't think it's for amateur investors, especially beginners. Besides that, the stocks are very sensitive to the fiscal policy, monetary policy, things happening to the industry and the company. As short-term investors, you will have to pay attention to the financial news and the policy changes, as well as know how they impact the security. Let me give you an example. A few weeks ago, Federal Reserve announced that they will take wait-and-see approach and hold the interest rate steady. Donald Trump was very unhappy about the decision, so he posted on Truth Social that Jay Powell should certainly lower the interest rate now, and Powell's termination can't come fast enough. When I saw the post, my expectation is that Jay Powell might lower interest rate due to the pressure from the Donald Trump. If that's the case, the stock market will go up. However, within hours after the post, the stock market went down because of the uncertainty that Trump might fire Jay Powell. I personally like to make short-term prediction about the stock market. However, I noticed that it's just hard to make prediction on the policy and investors' reaction towards the policy. Let me give you another example. On April 9th, that day that the trade war officially started, I was really looking forward to see the stock market reaction. A lot of people were predicting that the stock market would plummet. I didn't agree. I think that the stock market will hold steady unless there is some big news. Because based on efficient market theory, the stock price has already reflected all the public information. At the last second, Donald Trump hit the pause button. The market recorded one of its biggest single-day gains since World War II. The S&P 500 rose nearly 10% in a single day, while the Nasdaq surged almost 12%. Of course, the two examples I just gave are both about how policy affects the market. For short-term investors, you also need to spend a lot of time researching the companies and industries that you invest in. At the same time, you also need to develop your technical analysis skills. Secondly, risk. If short-term investors want to achieve considerable returns in a short time period, the ideal investment products are those with high volatilities, such as high volatile stocks, options, etc. As everyone knows, in the world of investing, returns and risks go hand in hand. If you want higher returns, you must be prepared to take higher risk. If you want to make 100% profit within a day, you must also be ready for 100% loss. Especially for day trading beginners who lack experience, I personally think the risks are just too high. It's fine to play with a small amount of money, but not with the money for your living expenses. Even the experienced investors can't always predict the market movement right. In fact, I don't really recommend relying on short-term investment income to cover daily expenses. If one day you fail to predict the market and have no income, you might end up losing the money for your future living expenses. So I think the money for daily expenses should be placed in more stable and highly liquid products, such as money market funds, high-yield savings accounts, or treasury bills. Speaking of high-risk investments, options definitely comes first, especially selling naked options. Of course, the returns can also be high. There's a lot to cover about options. I won't go into detail here. If you are a risk taker and have extensive investment experience, you can give it a try. But if you are an amateur investor and risk adverse, I suggest using options for hedging. For example, strategies like covered calls and protective puts. Besides selling naked options, Borrowing against the stocks and then using the fund for other investments is also very risky. Borrow against the stocks is also called margin loan. Since your existing investments are used as collateral, the interest rate is usually very favorable. In real life, some people use margin loans for emergencies, while others use them for investments, hoping that the returns will exceed the interest they pay and further boost their investment returns. However, if your new investment loses money, you will still have to pay interest on the margin loan. The worst case scenario is that if the value of your collateral drops significantly, your brokerage firm will force you to add more funds or even sell your declining assets without your consent. So, with high leverage, you gain not only higher returns, but also higher risk. If your income is stable and you have some liquid assets, using a margin loan to invest can surely give you more leverage. But if you don't have stable income or liquid assets, the risk is just too high. Last but not least, from tax perspective, gains from buying and selling financial investments within 1 year are called short-term capital gain and are taxed at the same rate as ordinary income tax. If you frequently trade, all the profits are subject to short-term capital gain tax, meaning a significant portion goes to Uncle Sam. Compared to short-term capital gain tax, long-term capital gain tax is more advantageous with a maximum rate of 20%. Long-term capital gains require you to hold investment for more than a year. I believe many people, myself included, prefer to hold investment long-term so that only long-term capital gain tax applies. Additionally, day traders need to pay attention to the watch-sell rule. What is a watch-sell rule? Generally, losses from selling stocks can be used to offset taxes. But if you buy back the same stock within 30 days after selling it at a loss, that loss can't be used for tax deduction. So a watch sale refers to selling a stock or a security at a loss and then buying the same or substantially identical security within 30 days, making the loss ineligible for tax deduction. So what happens to that loss? It can only be added to the cost basis of the newly purchased security. For example, if you bought a Google stock for $200 and then later sold it at $160, you lost $40. But if within 30 days you buy back a Google stock at $150, your new cost basis is $190 instead of $150. The $40 loss can't be used for offset taxes. Instead, it has to be added to the cost basis for the newly purchased security. Therefore, for day traders, you need to be aware of watch sale rules and make sure you file tax correctly. All in all, I think short-term investments require significant time commitment and carry high risk as well as tax disadvantages. Of course, some short-term investors do make big profits, but in my opinion, short-term investing is somewhat speculative. And as far as I know, many short-term investors also lose money. Whether you are a short-term or long-term investor, the most important thing is to learn to control risk while pursuing returns. That's all for what I'm sharing today. If you have any questions, please feel free to leave a comment and please like and follow my channel. I will see you next time. Bye!